How much of your retirement income will be guaranteed? Think about you're working now, you're saving money, investing money, you're probably planning for retirement. And when you think about retirement, yeah, the bucket of money is important, but what's more important is how much money will you be getting in retirement? Today, I want to talk to you about guaranteed retirement income, how you can make that happen. Think about your portfolio and answer the question, what do you have in your portfolio right now that will provide you 100% guaranteed income? Take a look at this, learn more, and enjoy the video. Our webinar is how to get lifetime income without market risk or losses using guaranteed annuities. I'm Barry Brooksby, founder of Focus Wealth Group. Tonight we're going to learn more about guaranteed income and really the importance of guaranteed income and how that plays a vital role in someone's life in retirement. Two main goals for tonight that I really want to help everyone understand and gain a lot more value with. Number one is understanding annuities. What are they? How do they work? And goal number two, how to use annuities to your advantage. And frankly, there are just some annuities out there that I don't recommend and people shouldn't be purchasing. I had a conversation today with someone that's in this horrible annuity and not sure what to do. So we definitely want to use annuities to our advantage. We're going to go through some case studies. And these case studies, a 70-year-old male, SPIA. What's a SPIA? A 60-year-old male, a DIA. What's a DIA? 37-year-old female, 50-year-old female, FIA. What are those? And then a 55-year-old male, an FIA with an income rider. You will understand all of this in great detail by the time we're wrapped up. And the case studies are really cool. I mean, there's some real life examples that I'm going to show you. You'll love the details. You'll love the numbers and how it all comes together. So a question, what's the number one fear of pre-retirees and retirees today? Just think about that for a minute. Did you guess running out of money? Number one fear, running out of money. And it's so prevalent that people retire and then all of a sudden, they're in this scarcity mindset. Don't want to spend down my principal. I'm not going to touch this money. They've worked a lifetime for income. They don't enjoy it. What happens? They pass away, and they leave all this money to heirs that they really should have spent and enjoyed while they were alive. So we can fix that. But take a look at these headlines. U.S. News, what happens if we all run out of money for retirement? It's a real fear. Stock investor, danger ahead, are retirees running out of money? USA Today, why many retirees will run out of money? And I just pulled a few headlines. There's just many, many, many more. The popular solution hasn't worked. What I mean by that, traditional financial planning, the way it's recommended to use income for retirement, it just hasn't worked. And this solution that hasn't worked is called the 4% rule, or the Monte Carlo 4% rule. The idea of being able to pull 4% off your total account value. So for example, if you retire with $1 million, we'll just use that as a round number, and that could be in a brokerage account, a 401k, IRA, it could be cash in the bank. Traditional financial planning says you can pull 4% a year from that account. Well, think about it. If you've got $1 million, it's only 40 grand a year of income. And if you got $1 million, you were probably making a lot more than that working. So what's it going to feel like if you only pull 4% a year from the million? 40 grand, it's not a lot of money, but here's the problem. It hasn't worked. And so more headlines. Financial Planning Association and the New York Times, Money, USA Today, they've all written about this. The 4% rule is no more. There's new math for retirees in the 4% withdrawal rule. Retirees ditch the 4% rule. They hoard savings instead. Another headline, the 4% rule is not safe in a low-yield world. Forget the 4% withdrawal rule. Money manager, quote, 4% retirement rule is broken. So if you think 4%, 40,000 a year is like pathetic, the new rule is less. It's about 2.8%. That if you want to stay safe with your retirement income and have it last through your mortality, the number is 2.8%. It's horrible. So that means that $1,000,000 that you thought you were getting 40,000 a year from is now only giving you 28,000 a year. And by doing that, you should not run out of money. Here's like the 4% rule chart. What this shows is if you're 30 or 35 years into retirement and you've been pulling 4%, you have a 75% chance of success, 25% chance of failure, that you're going to run out of money. So we come up here to 2.8. 2.8 is the number that they basically are saying you can't take any more than that if you want to have your portfolio sustainable. Forget 5% withdrawal, forget 6%, 2.8, definitely no more than 4. So it's this withdrawal rate. The 4% rule isn't working anymore for retirees. And here's an article from Morningstar. And it's basically, what are the safe portfolio withdrawal rates? I'm just going to highlight the conclusion. If anyone wants a copy of this article, you're welcome to email me. So this is Morningstar, and in their conclusion of this report, we find that a 4% initial withdrawal rate has approximately, they're saying, a 50% probability of success over a 30-year period, which is worse than what I just showed you in the chart. 50% probability. So it's like getting in a plane and the pilot saying, look, we've got a 50% probability of reaching our destination safely. Are you going to take the flight? No way. Well, this is your money. You don't want to risk the money and have a 50% probability rate. And last sentence, a retiree who wants a 90% probability of achieving a retirement income goal with a 30-year time horizon, 40% equity portfolio, would only have an initial withdrawal rate of 2.8%. That's where I came up with the 2.8. This is one study. There are many other studies that back up 2.8%. So the point is, on $1,000,000, how far is 28,000 a year going to go for someone? Not far at all. Not only is the 4% rule broken, but think about it. Most people sitting on these accounts in retirement, they're still tied to the market somehow. And so that means they're dealing with fees, they're dealing with volatility, the unknowns, what's going to happen to the portfolio. Could there be another crash like we had in 2008 and you lose 30% or 40% of the portfolio? You would hope that someone in retirement is going to reallocate into a safer portfolio, maybe some bonds or guarantees, but you would be surprised at the number of people in their 70s and even 80s that have a lot of risky investments. And who knows, we just don't know what the future holds. But there are no guarantees in a stock market investment or a mutual fund or an ETF. So fees, volatility, and no guarantees, just major problems. And look, the larger portfolio you have, the bigger detriment a loss can be. What I mean by that is if you're sitting on 100 grand in a portfolio and you lose 5%, that's a $5,000 loss. But if you're $1 million portfolio and you lose 5%, it's not 5 grand, it's 50 grand. So the more money you're sitting on in retirement in the market, the less ability you have really to go through volatility or a downturn. Hope that makes sense, right? In other words, the larger amount of money you have in the market, the more risk you're taking. And it's very, very volatile and can be very extreme. Why an annuity? Because you can get guaranteed income and higher withdrawal rates. What I mean by that is a distribution rate, a withdrawal rate. Instead of 2.8% or 3% or the 4% broken Monte Carlo rule, you can get much higher withdrawal rates. Double, triple, sometimes close to quadruple, depending on your age. But for under-promising and over-delivering, let's say 2 to 3 times higher, and it's fully guaranteed. So let's take a look at a few things. These annuities become a self-created pension. How great is a pension that you're going to get money for the rest of your life from a prior company? This is a self-created pension. In case study number 1, we're looking at a 70-year-old male
that has $500,000 that they want to allocate to what's called a SPIA. S-P-I-A, it stands for Single Premium Immediate Annuity. Now, you're not going to put all your money here, but let's again say this person has $1 million to $2 million of assets and they want to allocate a portion of that for guaranteed income. We'll use $500,000. In a single premium immediate annuity, the income starts within 12 months. So if you're 40 years old, you're probably not going to do this. It's more than likely you'll be 60 or older. In these case studies, I've done these before, and I've done them for 60, 70, even 80. I think I had a client 82 do a single premium immediate annuity. So as we go through the case studies, hopefully there's something in here that matches you, but if not, we change the ages and we put the numbers together and make sure it works for you. In this 70-year-old $500,000 SPIA example, check this out.
Here's the $500,000 going into the SPIA. This can be from an IRA, a 401k, cash, could be a brokerage account. In this example, I'm showing a traditional IRA rollover. And because it's an IRA, we roll it into a SPIA IRA. It's a tax-free rollover. You're not going to pay any tax on the rollover. You would only pay tax on the annual income or the monthly income. And in this case, for the 70-year-old, notice right here that the monthly income is $3,554. That's every month. This is guaranteed lifetime income. If we do the math on this, $3,554.15 times 12, that's $42,649 a year, guaranteed. And let's say this person lived to the age of 90, that'd be 21 years because we count the age of 70. That's $895,000 of total income on $500,000 that went in. If this person lives to age 95, we see that number here. They'd be paid out $1,066,000. What this represents is an 8.52% annual payout percentage. We call this a distribution rate. And if we look at the math, 500,000 times 8.52%, we get the $42,000 of income. That's remarkable. So you're getting a guaranteed 8.52% distribution rate. Doesn't matter what's happening in the economy or the stock market, these are guaranteed numbers. I often get the question, well, Barry, what happens if this person passes away before the $500,000 is exhausted? Well, in that case, we have what's called an installment refund. If he only received $100,000, the remaining $400,000 would go to beneficiaries. If he has already exhausted the $500,000, well, then there would be no money left over. There is another option, just to do a single life without the installment refund. That would bump the income up to about $3,800 a month, maybe a little bit more. But you can choose. If you want to do an installment refund where you never lose money, or if you want more income and do a single life, that's a personal decision. In those cases where someone just does a single life, what I recommend is that we take another portion of their assets and put it into a whole life insurance policy for $500,000 that would then cover the $500,000 in this annuity. So if you only spent $100,000 or $200,000 or $300,000 and passes away in a single life without the installment refund, there would be a whole life death benefit of $500,000 that would then go to the beneficiaries.
These income annuities, it's a way for you to protect your assets and guarantee a lifetime income that you can't outlive. Next case study. This is a 50-year-old female, $100,000 in a FIA. FIA, it's a fixed indexed annuity. With these fixed indexed annuities, this is really cool because when you decide to take income, that date is flexible. You're not saying, oh, I want income at 70. You get to choose when you want to take the income. The other thing that's really cool about a fixed indexed annuity, and these are probably the most popular annuities out there today, and the next one I'm going to show you is this. Think about compound interest in your mind. The way a fixed indexed annuity works is if the market makes money, because you're tied to an index, the S&P 500, some index that you're tied to, when it makes money, you make money. Some index annuities have a cap rate. Some index annuities have a participation rate. They might say, look, if the market earns 12%, you get to participate in 80% of that gain. Or if it earns 12%, you might have a cap rate of 5%. So no matter what happens, anything above 5, the insurance company keeps, but you get 5. However, if there are losses, you don't lose a dime. So your principal is fully protected, and any gains you have are locked in. It looks like this. You grow, you grow, you grow. If there are market losses in that year, you just flatten out. You don't lose any money, you just flatten out. And then when there are gains again, you get the gains. If the market loses, you lock in those gains, you flatten out. If the market gains again, you go up. If there's a loss, you flatten out. So this is the curve. This is the projection that you're going to see in a fixed indexed annuity. You can't lose money. So it's a way to protect principal. Very powerful strategy as compared to a normal stock market investment. Because look, if you're still invested in mutual funds or stocks and the market goes down and you're in retirement and you're taking income, you have a losing year, you're just adding salt to the wound. It's like double pain. If you're pulling 50 grand or 100 grand or 200 grand out of your stock market portfolio and there's a 5, 10, 20, 30% loss and you still need the income, you're taking income out of a negative portfolio. This prevents that because you do not participate in those market losses. Here's what this illustration looks like. So after I've just shared with you that growth curve where you lock in the gains, here's what that illustration looks like. And I'm only showing the market returning or the index returning a 5.3% return. And what happens is on the accumulated value, the account, if it were earning 5.3%, that's what the numbers would look like here, all this cash here. The next example, this case study, the 55-year-old male, $250,000, again, a fixed indexed annuity with an income rider. You can start the income at any time. The income date is flexible. This is, in my opinion, probably one of the coolest annuities out there because of all the benefits that you get from it. And I'm going to outline a few here. Before I get to the actual illustration, we need to take a look at the details of how this works a little bit. In this fixed index annuity with the income rider, what's happening is you do pay a small fee for the income rider. It's usually 0.9%, maybe to 1.2%. Usually the average out there is about 1% for the income rider. But it does not affect the income account. Here's what I mean. In this fixed indexed annuity, there are 2 buckets of money. It's one annuity, but there are 2 buckets of money. The first bucket of money, this is your cash account. And this cash account, this is tied to the index, like the S&P 500 or any other index. So I'll just say etc. And this cash account holds true with what I said just a few minutes ago, that it will not lose money based on what the index is doing. You can't lose money in this bucket of money. So as I showed you up here in this drawing, same thing holds true, all right? In this cash account, whatever the market does, besides losses, you get to participate in those gains. The second bucket of money in this fixed indexed annuity is what's called the income account. This income account is fully guaranteed. And guess what? When you're ready to take income, you get to choose which bucket performed the best and take the income from that bucket. So in the guaranteed bucket of money, you also will sometimes see a bonus on the amount of money that you put in, 5, 10, 15% up front, plus the return. Sometimes the return could be simple interest. Sometimes it could be compound interest. To clarify, make sure we're all on the same page with this. This is one annuity, but inside the one annuity, there are two buckets of money, the cash account and the income account. The income account is fully guaranteed, and we're going to look at an example of this.
Age 55, $250,000 is going into the annuity. This could be IRA money, 401k money, 403b, 457, money from a brokerage account, could be cash. Maybe you're sitting on some CDs that aren't paying very high interest. Regardless, this is a great place to put money because it's fully guaranteed, and then you can choose to take income when you want. But here's what I've been wanting to get to. This particular annuity has a first year 20% bonus on the income account. So when the $250,000 goes in, notice this year one income value is $300,000. $250,000 plus 20%, that's 50 grand, 300,000. And every year thereafter, through the 20th year, there is a 10% bonus on the income base. 10% of the 250,000 is 25,000. Year 2 then is 325,000. Year 3 is 350,000, etc. So this annuity right now is amazing because you're getting that first year 20% bonus and you're getting 10% bonuses years 2 through 20. It's fully guaranteed. These are net numbers. There are no fees that you're seeing here. These are net numbers that you earn. Let's say that this person wants to start taking income at the age of 68. The $250,000 has now grown in the income account to $625,000. What they can do at that point is get a 6.2% distribution rate. And if we look at the math, 625,000 times 6.2%, that's how we're coming up here with the $38,750 of annual income. You get to choose when you want to start taking the income. You can wait till you're 60, you can wait till you're 70, you can wait till you're 80, and you don't have to make the decision until you get to the year that you want to start taking the income. If this person waits to 68, they are now locked in at $38,750 a year. That's a guaranteed lifetime income payout that they can't outlive, which is remarkable. You want to look at a portion of your assets that will provide guaranteed lifetime income for you. It's going to give you more peace of mind. It's going to give you more predictability. This column here, which is the annual enhanced income benefit, simply means they will double your income if you had an issue like chronic illness, critical illness, terminal illness, and it is state specific. If this person waits to the age of 70, now the income base has grown to $675,000 with a 6.65% distribution rate, $44,888 a year. Guaranteed lifetime income.
Some things to be aware of. Okay, just be cautious of a few things in an annuity. One would be the surrender charges. Most of the annuities that I've shared with you tonight have a 7 to 10 year surrender charge. What that means, if you pull your money directly out, they're going to charge you a surrender charge. Could be 10%, could be 5%, could be 3%. Once that surrender charge time frame is over, there are no surrender charges. Now, people have asked, well, what happens when I start taking out income? When you turn on the income, that's not surrendering. You've flipped the income switch. You're now taking income. There is no fee to do that. There is no surrender charge to do that. The other thing that's cool is they do allow most companies a free 10% withdrawal. So in any given year, you can take out 10% of the annuity value, penalty and surrender charge free. Now, if you're in a 401k and you're over the age of 59 and a half, you would only pay the tax. If you've rolled over a 401k into an IRA annuity and you're under 59 and a half and you pull money out, well, you'd pay the tax plus you would pay a 10% penalty. So I help walk you through all that if you're looking at withdrawing or needing some cash, but usually 10% free withdrawal. The other thing you want to be aware of, some companies do charge other types of penalties and fees. So read the fine print. You also want to be aware of the cap rate and participation rate adjustments. Companies can change these at will, sort of. So you just want to be aware of, well, what are those minimum guarantees? Historically, what have they done? What you don't want to have happen is be in a situation where you've got a very long surrender charge that you didn't know about. You were expecting to take money fully out of the annuity or roll it into something else within 10 years, and you find out you got a 15-year surrender charge, and you're like, wait a sec, my advisor never told me that. And then variable annuities without guarantees. This is the one I've seen really cause people problems, because in a variable annuity, it is variable. It is fully tied to the stock market, and you don't have that protection against losses. So if you're in a variable annuity and it's not guaranteed and the market loses 20%, you're going to lose 20% in the annuity. So you've got to be aware of that. These are the major concerns to be aware of. When you choose the right annuity, all these things come to fruition. Guaranteed growth, guaranteed income, tax-favored money. You heard me say earlier, when you roll money from an IRA or a 401k into a qualified annuity, it's a tax-free rollover. You lock in gains, as I shared earlier. There's no direct downside market risk or losses. It's a way of a self-created pension. There's a potential long-term care benefit where you could get double income. There is a death benefit that's paid out to beneficiaries also if you don't use it. And what I love to share with clients is that when these are structured correctly and you're in the right annuity, you potentially can have 30 to 50% more spendable income. Not a 2.8 or 4% distribution rate, but potentially much higher than that, where the income value has grown significantly. So you're getting 30 to 50% more spendable income. That's the power of a guaranteed income annuity. In this study by Wharton Financial Institutions Center, they specifically talk about investing your lump sum at retirement and the safety and peace of mind that that can bring to you. Couple highlights. Here in the introduction, they state old rules of thumb for spending your assets in retirement called decumulation, which is the 4% rule that we talked about, need to be reconsidered. Those old rules need to be reconsidered. And again, they highlight here the 401k, 403b programs. There are no guarantees. You don't know what those investments are going to do. They talk about a life annuity is the only investment vehicle that features the ability to spend money at the same rate and have the money go as long as you live, right? Long as they live. One of their recommendations in the study is you should begin by annuitizing enough of your assets so that you can provide for 100% of your minimum acceptable level of retirement income. So that just simply means put an annuity in place that's giving you income guaranteed for life that's going to meet 100% of your minimum acceptable level of income. And here in this section, given the alarming confluence of economic and demographic changes occurring today, the number of people choosing life annuities should be larger than ever. If you'd like a copy of this article, reach out to me. And lastly, this Forbes article, Improving Retirement Outcomes with Investments, Life Insurance, and Income Annuities. Income annuities have such a power to bring peace of mind and guaranteed lifetime income to someone in retirement. The experts agree this should be a part of a retiree's portfolio. And even prior, planning for that. Consider your plan, consider your future, and how a guaranteed income annuity could help you. Well, thank you for attending the webinar. I wanted to share just some very powerful, simple case studies with you, how the annuities work. If you would like to see numbers for yourself, feel free to reach out to me. You can visit focuswealthgroup.com. This webinar eventually will be posted there, so you can check it out, the recording. You can email me, barry@focuswealthgroup.com, or call the office. You've invested in yourself tonight. Continue to learn, to grow, expand. If I can help you in the future, reach out. Appreciate you attending the webinar. Have a great week.